Hello there, I'm Windermere Real Estate's Chief Economist, Matthew Gardner, and welcome to the March episode of Mondays with Matthew. Well, we have lots to talk about this month, so let's get straight to it. And first off, let's take a look at the February existing home sales numbers. Now, as you can see in the top chart, the number of homes for sale was measured at just over 1 million units. Now, this is a woefully low number and one that we haven't seen since NAR started gathering the data on listing inventory. Well, that's a couple of decades ago. And the bottom chart, that shows home sales. Now, they fell by 6.6% month over month in February to a seasonally adjusted annual rate of 6.22 million units. But I would add that they were still 9.1% higher than we saw a year ago. Why the drop? Well, I am putting the blame squarely on the shoulders of home sellers who, quite frankly, simply aren't selling. And looking at sale prices, well, they ticked higher in February to a median of $313,000. And that matches the all-time high seen last October. And it's also 15.8% higher than we saw a year ago. And this is the fastest annual pace of price growth since August of 2005. But I have to add that the number is a little deceiving, as it was skewed higher by significant growth at the upper end of the market, with sales above $750,000 accounting for close to 10% of all sales in February, and sales above $1 million, well, they were up by a whopping 81% when compared to a year ago. The numbers also showed that homes took an average of just 20 days to turn pending. That is another record. And 74% of homes sold in less than 1 month. Individual investors or second home buyers, well, they purchased 17% of all homes sold in February, and that's up from 15% in January and the same as we saw a year ago. Now, as we move through this year, there are a couple of things worthwhile noting. Now, we all know that the market is tight. That said, I do still expect to see total sales in 2021 come in at around 6.3 million units. That is lower than the forecast that I put out in January, but it would still be an 11.6% increase over total sales in 2020. Now, although these are not numbers from NAR, I did want to share with you some different data that does relate directly to the increase in sale prices that we've just discussed. With the significant upswing in sale prices that we've seen over the last, 8 or so years now, over 30% of all homeowners in America currently have more than 50% equity in their homes. And this is a massive figure. But across the country, there are significant variances, as you can see here. The largest share of homeowners who are equity rich, well, they live in Vermont and down in California. But many West Coast markets are also not very far behind, with significant owner equity seen in Washington, Oregon, Idaho, Utah, and Colorado. These really are very impressive numbers. Okay. Time to take a look at mortgage rates, as there's certainly been a lot going on in that space too since we last talked. This chart shows the average weekly rate for a 15 and 30-year conforming mortgage. And as you can see, rates started to jump in early February. And I'm afraid I find it very unlikely that they're going to drop back down anytime soon, if at all. And I'm sorry, folks, but the days of 30-year rates starting with a 2 handle, well, they are now firmly in the rear view mirror. So, what caused this spike? Well, it's actually rather simple. COVID-19 case counts are dropping. The distribution of a vaccine is going, quite frankly, remarkably well. As I speak, over 130 million doses have been given, and over 46.4 million people are now fully vaccinated against COVID-19. But there's a problem with this. And the fear is that with the country starting to reopen as more of us get vaccinated, we're going to see a significant boost in economic activity, which, in concert with the latest round of stimulus payments, has generated rumblings from some economists who expect to see inflation taking off. And as much as it's great news, we're seeing a better than expected rollout of the vaccine, which will lead to faster economic growth in the second half of the year. The potential for inflation to rise is now elevated. And this has caused one thing, a move out of bonds, specifically 10-year treasuries, which means that the interest rate for these bonds has to rise to attract more buyers. And as you are all fully aware, the interest rate on 10-year paper directly impacts mortgage rates, specifically the rate on 30-year mortgages, which are by far the most popular mortgage product. But before everyone starts getting panicked about this, let's look at it in a slightly different way. Even at 3.17%, the number last week, rates remain remarkably low. Yes, the current rate, well, it's the same level we saw back in June of 2020, but it is still well below the long-term average. But that said, and given the upward move in Treasury yields, I've had to rerun my forecast models for mortgage rates. And here is where I see rates trending this year. I expect we'll see rates rise to an average of 3.6% by the fourth quarter of 2021, and looking further out, will likely break back above 4% in early to mid-2022. Now, I could actually be a bit optimistic if, and it's a very big if, 10-year bond yields rise faster than I'm forecasting, but for now, I don't see that happening unless, of course, inflation really does take off. But again, I really don't see that. That said, I am looking for a spike in inflation over the next few months as we feel more comfortable going out again and we start spending money in a more normalized manner. But I believe that inflation will, after a short period, relatively speaking short period, it will level off and not get out of control. But I have to say that if this does happen, if we do see an ongoing spike in inflation, then one thing will happen. Bond buyers, well, they'll leave 10-year treasuries, they'll head out further along the yield curve and buy longer duration treasuries, which is very normal to counter inflation. And that means that the interest rate on 10-year paper got to rise to attract buyers. That, in turn, could lead mortgage rates to increase, to get higher, faster than I am currently anticipating. And just in case you don't believe me, well, here's my forecast for the average rate in 2021 alongside some of my fellow economists. And as you can see, other than Freddie Mac, we are in a fairly tight range. I would add that both Freddie and NAR forecasts, well, they're about a month or so old right now, so I would not be surprised to see them revise their forecasts upward at some point. Moving on now to the new home market. Both permits and starts pulled back in February, with starts down by 8.5% on the month and single-family permits down by 10%. So, what's going on in that space? Well, despite strength in buyer traffic and a lack of existing homes to buy, our builders are slowing some production of single-family homes. Why? Lumber and other material costs continue to rise. And the shortage of lumber and other building materials, including appliances, by the way, are also putting future construction at risk. While starts for the first 2 months of this year are 6.4% higher than the first 2 months of 2020, there's been a 36% year-over-year increase in single-family homes that have been permitted but not yet started. Some projects, they've been put on pause because of the cost and availability of the materials needed to build those homes. And to give you some perspective about the direction, particularly of lumber prices, well, they have skyrocketed by more than 180% since last spring. And this price spike has done one thing. It's caused the price of an average new single-family home to increase by more than $24,000 since April of last year. This chart provides an overview of the US framing lumber pricing market, and you can see it is not pretty. But you can also see that the futures price has been dropping. Now that may mean we're getting closer to the end of the massive increases in lumber prices that builders have been facing for the past several months. Time will tell. Keep your fingers crossed. And on the sales side of the equation, after a slight rebound in December and January, the slowing of the pace of new home sales continued in February because of a combination of affordability challenges, more costly materials, and some storm effects, which in concert with each other led purchases of new homes to drop by 18% to a seasonally adjusted annual rate of 775,000 units. But I would add that the February sales rate was 8% higher than we saw a year ago. And we know there is still demand, which is being supported by still, relatively speaking, low mortgage rates, but more from solid demand in lower density markets like the suburbs and exurbs around our major cities. Inventory levels, they rose slightly with 312,000 new homes for sale, but that was 4.6% lower than a year ago. Median price came in at $349,400. That is up 5.3% from a year ago. And finally, I want to share this with you. I recently read a fascinating analysis that the National Association of Home Builders put out, which essentially suggested that the recent rise in mortgage rates over the past 2 months has priced more than 1.3 million households out of the market for a median-priced new home. In fact, the study found that just a $1,000 increase in the US median new home price would push 153,967 households out of the market. They wouldn't be able to afford a median-priced home with just a $1,000 increase in sale price. So, looking at it this way, the NHB created the affordability pyramid you see here. And it shows that as the price of new homes increases, the number of households in each tier that are able to afford it decreases. That is naturally all very logical. About 21.1 million households are estimated to have the income needed to buy a home, but it's got to be priced below $100,000. And that's shown on the bottom step of the pyramid. And of the remaining 101.8 million households in America who can afford a home priced at $100,000, 19 million can only afford to pay a top price of somewhere between $100,000 and $175,000. And they're shown on the next step. And naturally, this trend continues up the pyramid of house prices, with each step representing a maximum affordable price range, as well as the number of households who qualify. Although it's certainly possible to find households at the high end of the market, there are a lot more households at the low end, where affordability, it was always bad, it's now becoming an even more major concern. 71.1 million households in America could not afford to buy a median-priced new home. That's almost 58% of all households in the country. The bottom line is that increased development costs can and likely will price these households out of the market for a new home. And with the cost of existing homes also rising rapidly, for more and more households, reaching the American dream of home ownership is getting harder and harder. Now, I am sorry, I really didn't mean to end this on a low note, but the facts are the facts. We need more housing supply, and we also need home price growth to slow. Now, of course, price growth will slow if my mortgage rate forecasts are accurate, but it might already be too late for many who would like to buy a home. So there you have it, my take on the January housing-related data releases. As always, if you've got any questions or comments about the numbers we've looked at today, please feel free to reach out to me. I would love to hear from you. I always do. In the meantime, thank you for watching. Stay safe out there, and I look forward to visiting with you all again next month. Bye now.